Act 1. The Spark. Why would a country that sits on the world's largest reserves of nickel, thermal coal, and palm oil be running out of cash? To understand why global markets are suddenly panicking over Southeast Asia's biggest economy, look past the trading desks of Singapore or London. Look at a small plot of land in Sumatra. Imagine a palm oil smallholder. He spends his days harvesting oil palm fruit under a punishing equatorial sun, selling his crop to a local middleman who passes it to an exporter. But the price that dictates his livelihood is not decided in Sumatra. It is set thousands of miles away in Rotterdam. He watches the wealth of his soil vanish across the ocean. His own wallet stays stubbornly light. On May 20, 2026, Indonesian President Prabowo Subianto stood before Parliament in Jakarta and addressed that exact frustration. He delivered a fiery speech, breaking a long-standing tradition by presenting the macroeconomic framework himself instead of delegating it to his finance minister. His core accusation was direct. Indonesia has lost an estimated $908 billion in revenue over the last 34 years. Why? Because its natural resources have been sold on the cheap. Prabowo blamed decades of under-invoicing, transfer pricing manipulation, and smuggling through ports. Foreign companies and international middlemen were setting the price of Indonesian wealth while ordinary Indonesians saw very little of the upside. To fix this, Prabowo unveiled a sweeping radical policy. The government is centralizing the export of key commodities. Starting June 1, a newly formed state-operated enterprise called PT Danantara Samperdaya Indonesia, overseen by the sovereign wealth fund Danantara, will act as the sole exporter for strategic resources. Private entities will no longer sell directly to global buyers. They must sell to the state first. The initial rollout targets crude palm oil, coal, and ferroalloys, with more commodities to be added every 3 months. To lock down the wealth, the regulation mandates that exporters must keep 100% of their foreign revenues in Indonesian state-owned banks from June 1. But here is where the narrative shifts from a sovereign triumph into a high-stakes economic gamble. The markets did not celebrate. They panicked. Rumors of the announcement caused the Jakarta stock index to plunge 3.5% the day before. On the day of the speech, it shed another 0.82%, led by a massive sell-off in energy and materials. The Indonesian rupiah tumbled to a fresh record low past 17,700 per US dollar. To defend the collapsing currency, Bank Indonesia stepped in with a larger-than-expected interest rate hike of 50 basis points, lifting the benchmark rate to 5.25%. Prabowo wants to reclaim $908 billion of lost wealth, but the financial system is signaling that his timing could not be worse. Act 2. The Geography of Power. To see why this policy has triggered such an immediate shockwave, we need to stand where the commodities actually move. Picture the Mahakam River in East Kalimantan, a wide, muddy artery cutting through the heart of Indonesian Borneo. At any given hour, massive barges piled high with black mounds of thermal coal ride low in the water, floating toward the coast. From there, they head north toward China and India to power the grids of East and South Asia. Further west, across the Java Sea to Sumatra, the landscape changes to endless rows of oil palms stretching to the horizon. This single archipelago produces over half of the entire planet's palm oil, a ubiquitous ingredient found in everything from cooking oil in Kuala Lumpur to cosmetics in Ho Chi Minh City. This immense geographic abundance should make Indonesia a financial powerhouse. Yet the ordinary people living along these commodity corridors rarely feel like they are sitting on gold mines. A truck driver delivering palm fruit in Riau or a port deckhand loading coal in Samarinda is deeply exposed to import inflation. When the rupiah plummets, the cost of their basic needs, imported wheat, motorcycle fuel, and local food supplies spikes instantly. Here is the structural tragedy Prabowo is tapping into. Indonesia has historically functioned as a raw extraction zone. For 34 years, the nation's wealth has left its coastlines under a system prone to systemic revenue leaks. Exporters routinely underreport the tonnage or value of what is leaving the ports. Using transfer pricing, a company sells coal cheaply to its own subsidiary in a low-tax jurisdiction like Singapore. That subsidiary then resells it to the final buyer at the actual market price. That is a fancy way of saying a company sells to itself in a tax haven, books the profit there, and leaves Indonesia with nothing. The profit lands abroad. The tax revenue vanishes. The foreign exchange earnings stay in foreign banks. Prabowo's plan uses Danantara to dismantle this exact structure. By routing every shipment of palm oil, coal, and ferroalloys through a single state entity, the government aims to force transparency. They expect this mechanism to boost Indonesia's foreign exchange reserves by up to $150 billion per year. That is the pile of US dollars the central bank keeps to defend the rupiah when global markets turn against it. More of it means a more stable currency and more budget room to fund the schools, roads, and hospitals Indonesians actually use. Malaysia has operated a centralized palm oil pricing board for decades. It is not a coincidence that Kuala Lumpur, not Jakarta, has historically had more influence over the price Sumatran smallholders receive for their crop. Prabowo wants to change that equation permanently. Here is the core contradiction of resource nationalism. Prabowo is attempting to rewire the house while the lights are still on. The rewiring may be necessary to fix a faulty foundation, but cutting the wrong wire at the wrong moment plunges everything into darkness. Indonesia does not mine or process these resources in a vacuum. It relies heavily on foreign capital and international expertise to build the infrastructure that makes extraction possible. Consider the country's recent nickel boom, which relied on billions of dollars of investment to construct domestic smelters. The China Chamber of Commerce has already issued a sharp warning to Jakarta, noting that tighter quotas, new pricing structures, and aggressive intervention are rapidly driving up operational costs and threatening future capital commitments. By forcing private operations into a state monopoly trading system, Indonesia risks alienating the very investors it needs to develop the next phase of its industrial economy. If global buyers lose faith in the stability of Indonesian contracts, they will look elsewhere. Act 3. The money and incentive question. This entire struggle boils down to a fundamental law of economics. Owning a mine is not the same as knowing how to sell what comes out of it at the right price to the right buyer at the right moment. To understand the internal forces driving this policy, we have to look at the key characters orchestrating it behind the scenes. The architecture of this new trading apparatus sits with Rosen Roslani, the chief of Indonesia's sovereign wealth fund, Danantara. That is the government vehicle designed to invest Indonesia's national wealth for long-term returns rather than letting it drain away through leaky export pipelines. To execute the plan, Roslani established the new state operating entity, PT Danantara Sambadaya Indonesia. Look at who they chose to run it. They appointed Luke Thomas Mahoney as a director. Mahoney is the former Chief Strategy and Technical Officer at PT Val Indonesia and Chief Technical Officer for Val Base Metals. This is not a political appointment. It is a calculated corporate hire. By placing a veteran foreign mining executive at the wheel, Jakarta is trying to signal to global markets that this new state enterprise will possess institutional competence. They want the world to believe that Danantara can handle complex international trade logistics without drowning in bureaucratic inefficiency. But the corporate incentives are colliding violently with geopolitical and fiscal realities. Why is Prabowo doing this right now, less than a month before the strict June 1 deadline? The answer lies in the intense pressure building from the wider Middle East conflict. The protracted closure of the Strait of Hormuz has choked global energy corridors, keeping oil prices high and causing massive capital flight from emerging markets back to the US dollar. This global volatility has hit Indonesia right in the ledger. Every time crude oil ticks upward, Indonesia's state budget bleeds. According to current estimates from Bank Mandiri, every single dollar increase in the price of a barrel of crude oil adds an estimated $608 million in fiscal pressure to the Indonesian government. That is more money the government has to find or cut somewhere else just to keep fuel prices from exploding at the pump. With the rupiah dropping past 17,700 per US dollar, Bank Indonesia was forced to act. By raising rates 50 basis points to 5.25%, the central bank intentionally chose currency stability over economic growth. Higher rates mean more expensive credit for local businesses, more expensive mortgages for the growing but vulnerable middle class, and a slower domestic economy. Prabowo is running out of fiscal runway. He cannot easily cut fuel subsidies without sparking mass protests in the streets of Jakarta and Surabaya. He cannot stop the global oil market from climbing, so he is turning to the only major lever he has left: seizing total control of the foreign currency generated by Indonesia's own land. If private exporters are forced to deposit 100% of their billions in commodity revenues into state banks on June 1, the banking system gets an immediate injection of hard dollars to prop up the falling rupiah. The structural incentive here is survival. The government needs cash, and it needs it now. But by forcing this transition in a matter of days, the state is overriding existing private supply contracts and risking market disruption. Act 4. The consequence chain. Picture a palm oil trader in Medan, northern Sumatra. He has spent 20 years building relationships with international buyers, moving fast to capture shifting spot prices, closing deals before competitors can react. Under Prabowo's new system, he can no longer sell directly. Everything goes through Danantara first. If the new state entity gets the logistics right, his product still reaches the buyer. The price is better, the nation captures more revenue. His community eventually sees more investment in roads and schools. That is the optimistic scenario. And it is genuinely possible. If centralizing exports through Danintara successfully eradicates under-invoicing, the true volume and market value of every ton of coal and cargo of palm oil gets recorded transparently. Billions of dollars that used to sit in offshore accounts flow directly into state banks. The rupiah stabilizes, Bank Indonesia can safely lower interest rates again. The state treasury collects maximum tax revenues from its natural resources, giving Prabowo the budget room he needs to fund domestic infrastructure and social programs without blowing out the deficit. Indonesia evolves from a passive supplier of cheap raw goods into an organized commodity power that dictates terms to global markets, the way Malaysia's Palm Oil Board has done for decades. But look at what happens if the execution fails. By creating a state monopoly over exports, the government introduces a massive bureaucratic bottleneck. That same palm oil trader in Medan, used to moving fast, is now waiting for state approvals and state-brokered contracts. Shipments back up at the ports. Indonesian palm oil is already under intense scrutiny from the European Union deforestation regulation, a rule that says if buyers cannot independently verify that palm oil comes from legal, traceable land, European supermarkets stop buying it entirely. If everything is locked behind a state-run system with limited transparency, international buyers may walk away from Indonesian palm oil altogether. The smallholder loses his export market, not because his land is illegal, but because the new system made it impossible to prove otherwise. On the investment front, if foreign capital decides the regulatory risk is simply too high, instead of building new processing plants in Indonesia, investors reallocate to the Philippines, Vietnam, or Australia. The immediate drop in foreign direct investment easily outpaces any short-term gains from tax enforcement. The rupiah falls further, the central bank pushes rates higher, domestic industries choke. Act 5. The deeper implication. This entire crisis reveals something fundamental about the ASEAN region. Political independence is meaningless without economic sovereignty. But achieving economic sovereignty in a globalized world is one of the hardest maneuvers a developing nation can make. The $908 billion figure claimed by Prabowo is an eye-watering number. Whether it represents a precise accounting of 34 years of corporate exploitation or serves as a politically useful narrative to justify state intervention during a currency crisis, it highlights a shared regional grievance. Across Southeast Asia, nations are trying to break free from the colonial-era trap of exporting cheap raw materials and buying back expensive finished goods. We saw this when Indonesia banned raw nickel exports to force companies to build local smelters. We are seeing it now as Jakarta attempts to control the actual commercial trade pipelines of palm oil and coal. But this moment also exposes the deep fragility within ASEAN's economic structure. Indonesia is the largest economy in the bloc, yet its national currency and domestic interest rates remain at the mercy of a protracted conflict in the Middle East and the decisions of foreign commodity buyers. Resource nationalism feels powerful on a parliamentary stage. Its ultimate success is determined by the cold reality of global capital markets. Let us return one last time to that palm oil smallholder in Sumatra. Prabowo's fiery speech in Jakarta was crafted for him to promise that the wealth harvested from his soil stays in his country. Whether that wealth ever reaches his pocket depends entirely on execution. History shows that when resource trade is centralized, the old international middlemen are often replaced by a new layer of domestic gatekeepers. As Indonesia prepares to lock down its commodity exports on June 1, one question remains. When a government declares it is taking back control of its national wealth, who actually reaps the reward? The state, the citizens, or the next set of intermediaries?